So Janet Yellen has come out this week and has pegged October 18th as the day that the debt ceiling is reached. So from that point forward, the U.S. government may possibly default on its debt as it no longer has the funds to maintain its operational expenditures. So it could result in drastic cuts to Social Security payments, if not outright abolishment temporarily until the debt ceiling is agreed to be raised, cuts in military pay or outright abolishment of military pay, and other types of payments and transfers that are going out as the government is no longer able to borrow money to spend money, essentially speaking. Now, with the record deficits that have been running from the last year of the Trump administration and then the first year of the Biden administration, this could be catastrophic to the economy because previous debts that may come due will not, the government will not be able to cut enough of its expenditures, I believe, to even pay off or pay down any of that temporary debt except for what's already in the General Treasury account. And that General Treasury account is being drawn down even as we speak. I pointed out in a previous video that the General Treasury account had fallen below a critical level, and that critical level was $200 billion. And so now, as of September 29th, we are now below that $200 billion level. It's being, kind of supported somewhat because the government is seeing quarterly payments now. But you can see that starting around the summertime, we were seeing a very drastic drop-off in the General Treasury account because that was officially the point where the government was no longer allowed to raise any more debt. And so now Janet Yellen has basically extended that thread as long as she could, and she's signaling that October 18th is probably the point when she can no longer keep the government afloat, so to say, keep the government operational with just money in its checking account. As I predicted in a previous video, and I'll post that in the link, it's had two effects go on right now. One is that we're finally beginning to see the drawdown in the stock market. So the Dow Jones, from its reaching its peak back in mid-August, has corrected downward by 5%. The NASDAQ is down by 6%, and the Wilshire 5000 is also down by 5%. We're also beginning to see the uptick in bonds right now. This has really started going on since bonds really bottomed out in August, and the risk to these bonds, what originally caused the bonds to draw down was because new debt was not levied, but as we approach the debt ceiling, as I predicted, instabilities may cause certain investors to jump ship, dump U.S. bonds, and raise interest rates. Now, granted, a lot of this had to do with the Evergrande situation that was going on in China. See my videos on Evergrande. Just go to my channel and search for those videos. I think I posted 2 about them in the past week or two. That may have been a situation developed where foreign investors, particularly in China and Chinese banks, sold U.S. debt in order to raise cash in order to transfer back into the yuan. That's causing this run up. But one of the things that I predicted was that we should start seeing precious metals prices go up, and yet for the past month, we've only seen them plummet. So look at silver here. Silver a month ago was at $24 an ounce, and it's now piking around at $22. And it actually dipped down to below $21 an ounce this past week at one point. It dipped down to below $22 an ounce. So originally I had said that there was a floor that silver had been trading in between $23 and $28 an ounce and didn't really deviate much from that, but now it has broken through that floor. And although it rallied somewhat today, it's unknown whether that rally will continue. I had predicted that we should see a run up in gold and silver, especially in the last 2 weeks of the debt ceiling reach. So it's probably starting around October 4th. And the reason why I thought that was because we saw a run-up in precious metals during the last time we went through a huge debt ceiling crisis mode debate, and that was in the summertime of 2011. I'll pull up a chart or show to show that about its effects on the stock market. But I don't know if silver and gold will reclaim their previous levels of $24 an ounce and up above 1,800 or not by the time of October 18th. It should, but we're not seeing those money flows going out. So just to recap right quick, we're seeing money flow out of the stock market. So they're flowing out of equities. We're seeing them flow out of the bond market, but they're not going into precious metals. Where are they going then? Well, they're going into the dollar. So there's dumping for cash. Okay. So again, this is investors pricing in a temporary emergency situation due to volatilities. They're dumping the bonds because of the potential that the U.S. just may actually default on some of its debt or suspend some kind of debt payments, which may cause a further lifting of interest rates, combined with the Evergrande situation that's been going on in China. They're dumping equities because, again, there's that instability that's going on around the budgeting process, the spending bills, of whether they're going to pass or not, along with the debt ceiling. So they're flowing to cash. They're not flowing to precious metals because precious metals are a hard asset. Once you put money into precious metals, you don't intend to take it out for a while. Now, it's just a matter of time before I think that investors, especially as we get closer to that October 18th deadline that Janet Yellen has established, will start bidding up precious metals as sort of a hedge to protect themselves. And we could be seeing that late squeeze run up in gold and silver. So I may have been early, but I don't think I'm wrong on this. I could be off on this because, again, forecasting is as much of an art as it is a science. But I have been right on the first two accounts that we would see the dumping of equities and eventually a rise in bond interest rates. I think that trend is going to continue as we get closer to that threshold now. Now, on the offhand chance that Congress does decide to raise the debt ceiling before the deadline, then we should see these forces reverse and the Dow Jones should go up and bond interest rates should settle. With precious metals, kind of settling wherever they are at that time. I don't expect them to spectacularly drop and plummet, but I don't expect them to rise either. They could drop a little bit as certain money flows go out and go back into equities and bonds. So right now, investors are not pricing in that this is a long-term crisis situation yet. That's why your precious metals are going up. Instead, they're rallying behind the dollar, holding cash. They're holding this and they're just playing the wait and see. But I do think that with each passing day, we'll see the run up in the precious metals, and that's coming soon. Okay. So just keep an eye out for that. Now, as far as the stock market, if we're going to time out to say how low can the stock market go, I said that it could go as low as about 10 to 15%. But let's take a look at what happened with the Wilshire back in the summer of 2011. So here we are at Wilshire 5000 now. It's dropped 5% from its peak back in early September. Let's go back to 2011 right quick and see what happened in that summertime. So there's the drop right here. We can see the plummet here as the end of July comes due. Let's see how much the Wilshire actually corrects downward. Okay, so it seemed to be hovering around the peak here of about, let's just say 14,500, and it reached a low of 11,450. Okay, so that was a huge drop. That was a drop of more than 20% in the Wilshire 5000 stock market pricing of this index. So stocks ultimately corrected about 20% from reaching their highs in 2011. And as you can see here, here's where the catastrophic drop fell through because of the debt ceiling. And we might see a similar situation develop now. So we need to hold your horses on this and get ready. Steel yourself. This should be coming. Now let's take a look at what happened to the gold price right quick. I'm curious to see what happened to gold at this time. I'm going to hover around and see. We should have seen a run up in gold at that time. And if so, we should be seeing that develop again. So here we are in 2011, okay? So gold had already been in a bull market. That's one difference from where we are now. Gold did do a sort of a run up in 2020, but now it has broken that and it has been sort of in a lackluster downward trend. It's trading in this channel right now at the bottoming out of 1700 and the peak of 2100, but it is not in the upward trend that it was in 2011. So it's unclear of whether we're going to see this bump up in gold's price, because here we go towards the end of July. You can see how gold's running up and running up and running up, and this is where investors really started to panic, and we saw this top off of the gold price before finally settling. To me, especially as we get to those last 2 weeks, okay, so as we get to these last 2 weeks, we really should be starting to see gold have a little bit of upward pressure going on. Now, how much did gold appreciate here from its upward trend? We'll start it and mark it at the beginning of July. Looks like gold appreciated by a good 25%, okay? So gold's price appreciated by 25%. If we were to see something similar to that, that would mean that gold's price would likely reach about close to $2,200 an ounce, probably around this 2,100, probably, kind of approach or lift up to that peak. But now remember, that was while gold was on an upward trend. So if we price that in, I wouldn't count on gold jumping by 25% of its current price right now. Instead, we might see gold jump up to, say, $1,900 an ounce, maybe a good 10% jump or so. Let's take a look at what happened to silver's price, okay? Unfortunately, I don't have silver's price on this chart, so I'm going to have to pull it on this one. Let's see what we get here. And we should be seeing a similar trend to gold develop. So yeah, there's the run up in silver right quick. Here is the hallmark of 2011. Here's the midterm as silver did a sharp peak right quick. But again, silver was already in that bull market during the run up, okay? So because it was already in that run up, that momentum was already carrying it. So I wouldn't count on silver getting this huge 25% jump. Looks like it got that around the time of mid 2011 or not. I would not count on that right away. Instead, probably something similar to gold or something. We might see silver jump back up to, say, above $24 an ounce is where I think it will land before this. Now, with each passing day, let's say that Congress decides to go into overtime on the debt ceiling debate. Let's say that Mitch McConnell and Chuck Schumer in the Senate and Nancy Pelosi and Kevin McCarthy in the House really decide to push the edge on this and stand off each other. And let's say that we go for a short period of time where the government is technically, and I put this in quotations, shut down, in air quotes right quick. Then yes, we could really see silver and gold do a short-term takeoff as investors panic. But I would consider that a long shot at best. And probably speaking, we should be seeing this run up in the precious metals. We're probably going to start sometime next week, I think. Again, it's going to be unknown on just how hard and how fast that's going to drive, and it's really going to depend just on how much investors panic on this. It's been 10 years since we've had this huge debate over the debt ceiling, and circumstances are definitely different. So we could be seeing a real late game surprise when it comes to precious metals performance here. But just keep in mind that such a surprise is probably going to be temporary. Don't think that this is the official beginning of the bull market. Instead, count on inflationary numbers probably eventually over time pushing up those precious metals gently at first before going in and heading into a real true surging bull market, okay? So that's my take on this, guys. Guys, I'm looking at other metrics that come out. The gross output numbers have already come out, and I'm calculating those numbers along with the third quarter GDP revisions. I also want to go over Jerome Powell's statements to Congress that he made. There's a lot of good insights into that. And, I'll keep you guys posted on any kind of new developments that's going on into the markets right now. I know that China's going through a semi-energy crisis. I'll probably post a vid sometime this weekend talking about that. So we got a lot of things to talk about. I apologize for not being able to create a video earlier. This week has been very hectic, but I'll definitely I will most likely post another video tomorrow evening and then Saturday and Sunday. So guys, I thank you for watching this. Make sure you click a like on the video, subscribe to my channel if you haven't already, drop a comment, leave it down below. Let me know what you think about all of this. I'd be curious to hear you guys' take on this and create a learning experience from this. Click that notification bell. Anytime I make a video, you'll get notified whenever a new video of mine gets uploaded. And once again, thank you for watching. I'll talk to you next time.